Today we're going to talk about personal finance. This is the fourth section in chapter 10. And we'll start with a statement, is that money earned in a savings account is taxable. So when I do my taxes each year, not only do I need to look at my W-2s for my salary in order to report that, I also need to look at my statement from my bank, which tells me how much interest I've earned in the past year, and I have to add that to my salary for taxation purposes. Right? So money you earn in a regular savings account is taxable. An IRA, which is an abbreviation for an individual retirement account, provides some shelter against these taxes. So the government has, in order to induce people to save for retirement, the government has allowed you to find some shelter against the taxation of savings. And that's what individual retirement accounts do. There are generally two types of IRAs. One is called traditional. It's a traditional IRA, sometimes abbreviated TIRA. And how this one works is the following way. Money is put in before taxes and taxed on the way out. So you put in money that money does not end up being taxed. And then when you retire and you start withdrawing at a certain age, you will pay income taxes on that money at that point. So that's how a traditional retirement account works. The other type is called a Roth IRA. And in that type, the money is put in after taxes. And the growth is free. And you never have to pay taxes on the growth you get from a Roth IRA. Now, of course, the government could change its mind about that, but that's been the deal for many years, and it would be a tough political hit to change that, right? But of course, they are in charge, right? They're the ones. Yeah, okay. I mean, I'm talking about taxes, but I mean, you guys don't really pay taxes, so that doesn't bother you at this point, right? So. All right, so let's see how this works as an example. We're going to do a few examples to try to figure out why we do this and what happens because of this. So this first example. Suppose you deposit $5,000 in 2016 into a TIRA, traditional IRA. You earn 6% annually, and you are in the 30% marginal tax bracket. So we're assuming that any money we earn is going to be taxed at 6%. Sorry, 30%. And so we're going to answer a few questions. A, how much do you save on income taxes in 2016 by doing this? Okay, so in a traditional IRA, the money that you put away has not been taxed. And so that $5,000 that you put away for retirement, you don't pay the 30% tax on that $5,000. So you actually save 30% of $5,000. And that's $1,500. Okay? If you had not put that money into that sheltered account, you would owe the government an additional $1,500 right now. So that's how much money we save right now by putting that away. Okay. The second question now is going to be, how much will the deposit be worth in 48 years? Okay, so that's not too hard to answer either. We deposited $5,000 and it's going to grow at 6%. So this is 5,000 times 1.06 to the 48 power, which is $81,969.36. So that $5,000 saved for 48 years turns into $82,000 or thereabouts. Okay. Then the third question is, how much will you get if you withdraw at 48 years? You'd think, oh, I get 82,000. No, because that money has not been taxed yet. And so when you withdraw from the IRA, then you are taxed on that withdrawal. So you are only going to keep a certain percentage of it. It's a 30% tax rate, so you're only going to keep 70%. And that's $57,378.55. That's what you have remaining when you withdraw that money. But even still, you can see the appeal of this right now, right? The appeal is that I lose $5,000 today, but in 48 years, I have something perhaps equivalent to what I need to survive. And all I gave up was $5,000 today. But you have to be someone that values your future self in 48 years to do something like this, right? Okay, so that's the first example now. But here's what we're going to do. We're going to compare this with our second example. We're going to compare this to a traditional savings account. In the following way. If we were going to just put this in a regular savings account, we don't have $5,000 anymore to invest because we have to pay taxes on it. So we can only invest $3,500 because we had to pay taxes on that $5,000. Instead of hiding that $5,000, it's out in the open and so it gets taxed. So now I can only put away $35,000. So, or $3,500. So $3,500, even if we could grow at the same rate, we get $25,218.46. Let me check this, make sure this is right here. Nope. Okay, 67. Oh, okay. Nope, I made a mistake here. Okay. We can only invest $3,500, but also we owe taxes each year on the growth. Okay, that's what I was forgetting. We also owe taxes each year. And that's bad because instead of 6% growth, we only get 70% of 6% growth. And 6 times 0.7 is 4.2%. So it's only 4.2% is what we earn because we have to pay taxes each year on that, on the earnings. So then what do we have at the end of 48 years? We have 1.042 raised to the 48th power, and then we multiply by 3,500, and we have $25,218.46. Okay. So we see how powerful that idea of sheltering the money from taxation and allowing that money to grow is. Okay, that's a big difference. Okay, so that's an advantage of these retirement accounts. Okay. Now, the third example is going to be another counterfactual. Suppose instead of TIRA, we contribute to the Roth IRA instead. Let's see what we have then. So now we put away, instead of putting away $5,000, we only have $3,500 to put away because we pay taxes beforehand. But now the growth is tax-free. So when I take 1.06 and raise it to the 48th power and multiply it by 3,500, that's all money that I get to keep. Taxes don't come out of this anymore. And we get $57,378.55. And note, that's the same amount of money that we had from the traditional IRA. So there is some equivalency here, and you can make a mathematical statement to this fact, right? If and the book does this, it says it calls this the equivalence of TIRA to Roth IRA. Comes in the fact that contributing P dollars to TIRA, letting it grow, and then get taxed, is the same thing as contributing P minus taxes dollars to the Roth. However, so that makes it that you might think now then it doesn't matter whether you're going to do a Roth IRA or a traditional IRA. But there are two further points that the book doesn't discuss, but that I want to discuss here, that would be involved with your decision making in such a process. The first one is that you are actually limited to what you can put in an IRA. I think the book says $5,000 or $5,500. That changes over time. Currently, it's $6,000. So I can put in $6,000 into a traditional IRA or $6,000 into a Roth IRA yearly. I'm limited to how much I can put aside. That's the limit. So in some sense, if you have spare money to save, the Roth is a much better place to put it because you can actually invest more money in the Roth because you're investing after-tax money. It's the same $6,000 for both types of accounts, but the $6,000 you put in a Roth has already been taxed. The $6,000 you put into a traditional IRA has not been taxed, and so after-tax money is more valuable. So in some way, if you're bumping up against that contribution limit, the Roth is better. Right? If you're only going to put away $2,000, it doesn't really matter from that standpoint. But if you have enough money that you're going to make the maximum contribution, either way, the Roth is better because it's been taxed. Okay. The other consideration is tax rates. When you are in your highest earning years, you will probably be in a higher marginal tax bracket. When you are in retirement and not making money anymore, but just spending your savings, you are likely to be actually at a lower tax bracket. What do I mean by that? I mean by, let's say right now, every extra dollar I earn, I pay 40% in income tax, just a number out there, because my salary is of certain, right? But I'm saving a lot of that. I'm not spending all of it. And when I retire, I won't need to spend as much money as I'm spending now. And so instead of taking out the equivalent of my salary when I retire, I'm taking out less than that. It's unlikely I'm going to be taxed at 40% for that money. I'm going to be taxed at a lower level because I have a lower income. So you might be saving, for a traditional IRA, if you are a high earner, a traditional IRA can make some sense if you expect to pay a lower tax rate in the future when you retire. But of course, you're kind of depending on tax rates being lower in the future, and so you're kind of trusting the government to do that, right? But of course, with an Roth IRA, you're trusting that the government actually isn't going to touch that money at any point, and they haven't. But they make the rules, so they get to say how things happen. So there's some debate as to what you want to do, and which one you might choose to do when you get older is, it involves some thought. You should give it some thought and think about it. I personally think that the Roth IRA has some serious advantages to it, especially because if you are a good saver, you can contribute more into a Roth because it's after-tax money. But either case is a good idea to do. It is good to save money because money gives you options and allows you to choose some things. So now I'm going to do this next example is going to be comparing two people, and this is a very preachy example actually. So, and if I can just underline, okay. So we're going to suppose two people have two different retirement saving strategies and compare what they have from that. So this is the example here. So suppose that Earl and Larry have IRAs. They are the same age, and that age is going to be 20. But Earl deposits $5,000 right away. For 12 years. So he's putting in $5,000 every year for 12 years. Larry instead does not invest right away, but starts putting $5,000 away each year after 12 years. And the question is, who has more money in 48 years? Okay. So Earl puts $5,000 away for 12 years and then puts nothing away for the next 36 years. Larry puts nothing away for 12 years and then starts putting away every year for 36 years thereafter, $5,000 away. Okay. So let's take a look at how much Earl has. And we're going to assume 6% growth. So Earl. Okay. So the way we calculate Earl is we use the formula for an annuity, future value, and that means we take 5,000 times 1.06 to the 12th years minus 1 divided by 0.06. That gives us the value of his account at 12 years. And then we're going to have to grow it for 36 more years when we're done. But this is the annuity final value calculation. When we do this, we get $84,349.71. Okay, then he stops contributing, but the money still grows at 6%. So I multiply that by 1.06 to the 36th power, and I get $687,218.34. So that's how much Earl will have 48 years later when Earl is 68 years old. Earl saves for the first 12 years, and then he says, I think I'm good. I'm done saving. Or maybe he's got expenses, he's got kids, things like that. Okay. Larry, however, he has a good time in his 20s, and he doesn't save any money. And then at some point, after 12 years, he finally wises up and says, I should save money. To do Larry's, you just need an annuity future value formula. So $5,000 each year for 36 years would be this formula. Okay, that formula is going to tell you how much Larry has. Larry has $595,604.33. So by delaying saving money for retirement, Larry actually has to put away money for twice as long. He has to put away, 3 times as long, 36 years, right? He has to put away money for 36 years, and he still doesn't have enough as much as Earl. He's still less than Earl. Right? The moral lesson here is money you save early gets to grow for a long, long time. So if you are in any position to save money in your 20s, that money is very valuable. It grows for a long time. So keep that in mind. And now I'll sign the homework. This is section 10.4, 3, 4, 5, 6, 7, 8, 9. So 3 through 9. Okay. And then we'll start logic on Wednesday.